Hey everyone, welcome back to my channel. My name is Bandis, and today I'm going to talk to you about KDA. Josh Bob, come on man, not that KDA.
I thought this was about League of Legends.
Redo it, come on. Alright. Hey everyone, welcome back to my channel. My name is Bandis, and today I'm going to talk to you about KDA. You're actually useless.
What? Not Call of Duty either? I thought this was a gaming channel.
I'm talking about this is a cryptocurrency channel, not a gaming channel.
Crypto? Man, who's investing in crypto? Alright, fine.
Redo it, come on. Hey everyone, welcome back to my channel. My name is Bandis, and today I'm going to talk to you about Kadena, or KDA. So Kadena, or KDA, is a proof-of-work blockchain that is a layer 1 smart contract platform that was inspired by Bitcoin. So it's actually the first sharded proof-of-work blockchain, and they boast they can get up to 480,000 transactions per second. Mind you, Ethereum can only do about 15 to 25 transactions per second, and Bitcoin can only do 7.
Stan's a loser! Stan's a loser!
On top of that, they claim that if they just add more chains or more shards to their blockchain, that they can infinitely scale. While similar to other sharded blockchains, theirs is a bit different that goes off what they call the Chainweb protocol and braided chains. And we'll talk about that a bit more in the video, but it's actually a bit different from what proof of stake is and what Ethereum 2.0 is trying to achieve. Kadena has even seen a lot of price action recently, going up 50x in the past year. Man, I can't imagine if my video went from 50 likes to 2,500 likes. That's a 50x. Well, you can help with that by hitting the like button below and spreading my channel to other people. Now let's get back to the video. The purpose of this video is to talk about Kadena, where it came from, who created it, how it works, and why it did a 50x in the past year. So the project was actually founded by two people, Will Martino and Stuart Popejoy, that both actually came from high up positions in JP Morgan. At JP Morgan, they both worked on blockchain technology, and that's what inspired them to actually go and create Kadena back in 2016. They were also inspired by Bitcoin, and that's why they actually chose proof of work. They felt that proof of stake and what every cryptocurrency is trying to go for with proof of stake, like Ethereum, is too theoretical, and they feel that proof of work is actually battle tested, especially considering that Bitcoin since its inception has never suffered any downtime. They felt because of that, proof of work was the way to go. But they knew by going with proof of work that they were going to have to be able to scale it, because as of now, Bitcoin can only support 7 transactions per second on layer 1. But they felt they had a solution in order to scale it while also keeping what they believed was the most optimal decentralization and security on the platform. And they believed their unique solution with Chainweb protocol and braided chains was going to be the unique and most optimal way to scale a layer 1 blockchain. But let's talk about experience. So who are these founders? Well, first, let's talk about Will Martino. So Will actually worked at JP Morgan as a VP for a special open source project named Juno that was designed for smart contracts. He also has experience with, wait for it, the SEC. And before that, he even went to Yale for his BA in mathematics and economy, more specifically fractal geometry. In this time between Yale and JP Morgan, he worked at a multitude of companies in many different roles, either as a software engineer, a quantitative researcher, and much, much more. He even worked at Yale as a researcher for many years in fractal geometry while he was working at these companies. His partner in crime, Stuart Popejoy, also came from JP Morgan, where he was the executive director for the new products division. Now, Stuart's background also casted a wide net where he worked in many positions, even as a programmer at a company named Apple, and he also found himself in many high positions at many trading companies. On top of that, they have a team that comes from many reputable companies like Microsoft, Apple, and much, much more. But most importantly, they have Dr. Stuart Haber, who is the co-inventor of blockchain and the most cited author in Satoshi Nakamoto's Bitcoin white paper, as an advisor to their team. So in terms of the team, I would say it's a pretty stacked team with a lot of experience at many reputable companies. And the entire team has been working on Kadena since 2016, and they actually had their mainnet launch in October of 2019. Since then, they've made many updates to the protocol, added more shards, created bridges between Ethereum, and plan on adding more bridges to Terra Luna, Polkadot, and many more chains. And since 2019, they've continued to grow and cultivate their project, and it was only recently when they launched their Ethereum bridge that really did the project start getting well known and growing, especially in this bull run. But okay, since now that we know a little bit about the background of the founders and the project itself, how exactly does this project work? What makes it different from Ethereum or other layer 1 smart contract platforms? loops. Well, like I said before, Kadena is a proof of work blockchain. Many new projects for layer 1 are actually trying to go to proof of stake, like Ethereum with Ethereum 2.0. In the next few months, they plan on going to proof of stake. Ethereum and many other layer 1 smart contract platforms believe that proof of stake is the future because it consumes less energy, is what they consider more secure and more decentralized. Kadena believes that proof of stake is theoretical and has not proven itself yet, whereas proof of work has proven itself with Bitcoin. Because of that, they decided to work on a proof of work blockchain, but the main issue that they faced was scalability. But they felt they had a unique protocol that would be able to solve the scalability crisis in proof of work. So now comes in Chainweb protocol and Braided chain. So what is it? So let's start from its most simple components. You can think of Chainweb protocol as having many sharded chains, the same way you would see Ethereum 2.0 eventually when it comes out, having 64 sharded chains that all connect to the main beacon chain for Ethereum. You see this with a lot of other proof of stake consensus protocols, although with Kadena what they're trying to do is, one, they're trying to do it for proof of work, and two, there is no main chain. So how does that work? Well, that's where braided chains come in. Essentially, each chain would reference each other and validate each other's blocks. So now instead of having one chain process all the transactions like you see on Bitcoin, you would have 10 chains or 20 chains or essentially thousands of chains eventually, processing all these transactions, and they would all reference each other. However, the first approach to this wasn't necessarily the most optimal. The main reason for this is you can think of 10 chains for the Chainweb protocol. If you had 10 chains, each chain would have to validate and store 9 chains worth of transactions rolled up into their one block. This essentially makes a lot of redundant data and makes the block grow infinitely, and makes it very hard to scale once you get up to, let's say, thousands of chains. And if you're curious about how Kadena stores its neighbors' chains transactions into its own chain, it uses Merkle proofs, which I actually talked about in my most recent video where I talked about loop ring. But go check that out, it's in the top right. Then they took another approach. Instead of having every chain reference all the other chains, they said, let's just reference the neighbors. The issue with that is that with 10 chains, to get from the current chain to the furthest chain, it would take about 5 hops. And then if you had 100 chains, it would take about 50 hops. So you can kind of see that once you add more and more chains, it takes longer for the tokens to get from one chain to all the other chains. So that posed a problem too. And this is where graph theory came in. Essentially what they did is they increased the amount of neighbors they had and balanced those neighbors. They had to be mindful of how much data they were storing for each block to validate all the other chains, but at the same time, they had to monitor all the hops that it would take to get from one chain to the furthest chain. So what they did with 10 chains is they said each chain would validate its 3 nearest neighbors. By doing this, they made it take only 3 hops to get from the chain they're at to the furthest chain. On top of that, instead of storing about 9 chains worth of data into each chain's block, they reduced it to 3. So essentially they were able to manage the block storage and how many hops it would take to get from one chain to the other, while also processing transactions now on 10 chains instead of 1 chain. The idea with this is that eventually they can add more and more chains to what they believe is thousands. Even right now, they scaled from 10 chains all the way up to 20 braided chains. And by combining this with proof of work, they essentially utilize miners to be able to validate transactions on each chain, while each chain would be able to validate the neighbor chains. And essentially what they did by combining Chainweb protocol with proof of work is that they said miners could either mine specific chains or they can mine all the chains at the same time. And when you're mining a current chain, you're also validating the neighbor chains at the same time. Make sure that essentially the security is there and that people aren't submitting faulty blocks or malicious actors aren't present. Not only that, they claim that with their consensus model that the energy consumption of this would be actually a lot lower, because I think we've all seen in the news that proof of work and Bitcoin has gotten a lot of hate in the news about environmental issues, and that it's consuming more than many nations to actually validate the transactions on Bitcoin. And the next component of Kadena is their smart contract language platform known as Pact. Pact is essentially advertised as a better solution to Solidity, which is Ethereum's language, mainly because Solidity is known as Turing complete. Essentially all that means is that Ethereum's Solidity language can provide support for recursion and loops and can essentially achieve any computation you can think of. Pact, on the other hand, is actually Turing incomplete on purpose. They don't allow infinite recursion or infinite loops. The reason for that is they believe Ethereum's Solidity is too dangerous and is what led to the DAO hack back in 2016 that led to the split of Ethereum and Ethereum Classic. So Pact and formal verification is actually for them seen as a better alternative because they believe that they don't want millions of dollars to be at hands of hackers due to developers' bugs. They want to ensure that there is a lot of safety. Because of that, they reduce the amount of limitations to developers when they develop on their smart contract platform. So these are the main technical components that actually separate Kadena from many other blockchains. It's definitely the first for me. Many new blockchains are incorporating proof of stake and sharding and layer 2s, but Kadena is really focused on incorporating proof of work and their own unique Chainweb protocol. So now let's talk about their roadmap. So recently this year, Kadena actually got to see a decentralized exchange built on their protocol similar to Uniswap, and this exchange is known as Kadena Swap or KDEX now. So unfortunately with this swap protocol, there's only one trading pair, and it's between the KDA token and a token named Flux, which is just a Web3 token. So I'm surprised that there's not many more trading pairs, and I'm assuming from what I can tell, there's not much activity on this actual swap protocol. And even most recently this year, Kadena was able to develop an Ethereum bridge that allowed Kadena tokens to transfer between Kadena's ecosystem and Ethereum's blockchain, where they had wrapped Kadena on Ethereum. So it's good to see that they actually developed also an Ethereum bridge, because many chains now have actually developed that bridge to Ethereum just because Ethereum is the largest ecosystem out there right now. But they do plan on supporting more chains like Celo, Polkadot, and much more. Oddly enough, Kadena has a bonding or staking platform to validate transactions between Ethereum and Kadena, which essentially is just saying that they're using proof of stake. They were also really talking down on proof of stake and saying it's theoretical. I'm actually a bit confused about this. I tried researching more and finding answers about this and didn't really find anything sufficient. So I'd be curious from the Kadena team why they're utilizing proof of stake to validate transactions between these two bridges. But that's besides the point for now. They've even seen NFT collections come onto their platform like UFO in this recent NFT craze. And in terms of the future, Kadena is looking to add more wallet support and more bridges to different chains. It also seems that they're trying to get more marketing out there to get developers to come to their platform. But as of now, it seems like Kadena's ecosystem is pretty dead, which is kind of surprising when we look at the price of Kadena. So if we look at the price of Kadena, we see that it went all the way from 20 cents a year ago today to about $12.83 today. About a 50x, and even at its most recent peak, it essentially did 100x because it went up to about $25. Now granted, a year ago, the market cap of Kadena was very low. It was about $9 to $10 million, so it made sense why it was able to move so hard right now. If you compare Kadena to other layer 1 smart contract platforms like Ethereum or Cardano, etc., essentially say it has much more room to grow. But I think it's honestly had its run up for this bull run. Can it still multiply a bit? Sure, but honestly I think there's more downsides at this point than there are upsides. For one, based on Google Trends, the hype for Kadena has died down quite a bit and it hasn't really recovered much. On top of that, the subreddit only has about 8,000 people, and sure, you might say the subreddit is not a good indicator. I try to combine all these indicators together, and only having 8,000 people a part of your community is not the best. On top of this, there's the real world issues that we're seeing with the Omicron variant, with inflation and tapering. There's a lot of indicators that might say we see a stock market crash, which could also lead into a crypto crash. Pretty uncertain in terms of the future right now if we even do have a continued bull run, but even in the best case, if we were to see a bull run continue, I don't think Kadena is going to have the biggest momentum to really make the price go up. Can it 2x? Can it 3x? Sure, but I feel like the chances are it could go down more than it can go up. I think there's better assets that I can actually invest in right now. But even if we did go into a bull run and the momentum was there for Kadena, I don't think I would invest into it, and here are my reasons. So before in this video, I tried to keep it all to the facts about the tech, about the roadmap, tokenomics, who the founders are. And now I'm going to talk about my opinion of Kadena, and honestly, I don't have the best opinion of Kadena compared to other platforms. So for the first reason, like I alluded to before, there's not much activity on the network. There's not many projects. You kind of have a Uniswap clone, which is KDEX, on the platform, but they only have one trading pair. There's not much volume, as I can tell, on that trading platform. On top of that, they have like an NFT collection recently that was added. But other than that, there's not many projects that I can actually find on Kadena. To go with that, I have some issues with their vision. They make a lot of claims that proof of work is better than proof of stake. I'm in the camp that actually proof of stake is a lot better than proof of work. They essentially say with proof of stake that it leads to less centralization and less security. I don't actually agree with that. I think proof of work at the very least leads to more centralization. The main reason for that is if you look at proof of work, in order to mine, you need to buy mining rigs. Mining rigs aren't cheap. Even if I wanted to make my computer mine Bitcoin, it wouldn't be too profitable. I would need to increase my hash power to actually be able to mine Bitcoin. But let's say with Cardano, if I wanted to stake, I can easily with my 5 Cardano put it into a pool and stake. And you might say, oh, well, if you're putting it into a pool, it centralizes. And to some extent that is true. But the thing is, with mining, there are mining pools. And there's a large few mining pools on Bitcoin. So essentially with proof of work, you have a larger barrier to actually get in and participate in the network, which then essentially leads to centralization. Whereas proof of stake, anyone with the token can really participate. It really depends on the platform, but most people, if you have some of the token, like Cardano, you can just stake even if you have 1 Cardano. I actually don't agree with their claim of proof of work. They say that proof of stake is theoretical, but actually in the last few years, it's been pretty successful on platforms like Zilliqa and many more. It's also odd that they talk bad about proof of stake, but then they pretty much use the same consensus model when it comes to their bridge and validating the transactions from Ethereum to Kadena. That doesn't really make sense to me. I like to really get answers to that, because it kind of feels hypocritical. Then there's the bigger issue for me, where they say that they can essentially infinitely scale by just keep adding chains and adding chains. They say that right now they have 20 chains, but they can get to thousands of chains. They essentially say that they can add more chains without compromising security or decentralization. The issue with that is it goes against the trilemma where these security and decentralization and scalability is all connected. If they solve the trilemma problem, I'll be super happy. I mean, they've paved way for the future. The issue with that is that they really haven't provided any proof that says they can add thousands of chains while also keeping the same decentralization and security. In fact, it's theoretical. Yeah, they're using proof of work, which they say is battle tested, but it's their own unique proof of work with their own unique Chainweb protocol. So at the end of the day, they're doing theoretical things too, similar to the way Ethereum is doing theoretical things in the same way that every other platform is doing theoretical things. My main issue is also with security. I feel that miners could easily just mine one chain or neighbor chains along with it and really either halt the network or submit faulty blocks. When Kadena had a response to this, they didn't really provide a sufficient response. They essentially said just because of, game theory that, now people aren't going to be malicious actors because they're incentivized to go on chains that have less hash power to get more reward. But at the end of the day, you're seeing people hack platforms not because of just money, but because they want to break the network. What about people that really believe in Ethereum and other platforms that become malicious actors by coming to Kadena and taking down the network? They don't care about the money. Some people don't care about money. Some people really want to be able to take down a network. It's also about pride. To say that essentially, because people are incentivized by money and game theory, that they won't take down the network isn't really a sufficient response to me. And I think if they continue to add multitudes of chains and spread the hash power between all those chains, I think it makes it easier to attack the entire network. They also claim that Kadena is more energy efficient than Bitcoin. The issue I have with that is I couldn't find any proof in their white paper or articles on Medium or anything that states why that's the case. Because essentially, even if they make 20 chains compared to Bitcoin's 1 chain, at the end of the day, hash power would be spread out across all those 20 chains. So if Bitcoin, for example, takes 1000 gigahertz of hash power, and then that is split amongst 20 on Kadena, well, each one would be averaged out at 50 times 20, and you're back at 1000. So it doesn't really make sense how just spreading the hash power across chains would reduce the energy consumption. To me, it's additive and it would be exactly the same. So that one is also confusing and I couldn't find a really good answer to that question. And then I think another reason, and this is probably more of an emotional response, is I am personally not the biggest fan of the founders. I've only looked recently at the founders and researched into them, but if you look even recently and even further back, they spend a lot of their time talking shit about Ethereum and the entire platform. They also spread a lot of misinformation when it comes to layer 2s, saying that why hasn't Ethereum been able to scale with layer 2s yet, and said they've been doing it for years, when in reality it's only still been very recent in the last couple of years. And they also make claims of like, why didn't they just increase the block size, which has its own issues, and if you're well researched into it, you would understand why increasing block size isn't kind of the solution. I mean, look at Bitcoin Cash, for example. They tried to do that with Bitcoin. I can't tell sometimes if the founders make comments on Ethereum because they're not knowledgeable or if it's just because they're being disingenuous. Either way, it doesn't bode well. I also just don't like the fact that they're constantly talking shit about Ethereum, who for a reason, has the largest ecosystem as of now. I believe that the future of blockchain is going to be interoperability. I think all these chains have their purpose, and I think all these chains are going to be talking to each other, hence why there's bridges between all these platforms and everyone's trying to bridge to Ethereum. It almost feels like to me that Kadena and its founders have tried to ride the wave of Bitcoin and the hype of Bitcoin by saying, oh, proof of work is better, it's comparable to Bitcoin because Bitcoin is the most popular, it's better than Ethereum, and it's like sharded, and it's like their own unique Chainweb protocol. At the end of the day, a lot of this also feels very theoretical, which is funny because they talk constantly about proof of stake being theoretical, but their entire consensus model and their entire protocol is theoretical, and they really haven't provided enough sufficient reasons of why it would work, essentially. Not only that, they don't have much traction to their platform. It feels odd. It's almost like it's a pump and dump, but I know it's not. I mean, they have a large pedigree in the background, but I think because of the founders and because there's so many unanswered questions about the Chainweb protocol, I can't find myself to actually invest in it. I mean, to each their own. I just think there's better layer 1 smart contract platforms. But anyway, guys, if you like the video, hit the like button. It really helps get my videos spread to more people. And if you like my content, just hit the subscribe button. I plan on making 2 videos a week, so stay tuned for that. I talk about everything related to cryptocurrency, whether it's news or tech. Thanks, guys. Have a good one.